Welcome back to another deal of the month video. So today I'm going to take you all the way to Brisbane, but we're going to look at a slightly different asset type than what we're used to. So today we're going to look at an inner city retail asset. And the reason why we're looking at this is because, well, there's a few reasons. One is there's a huge value add opportunity, but secondly, the location and position of it is superb. So we're looking at the building right now. So as you can see, this building is in a prime corner position in a suburb called Milton. Now, anybody who's been there, who knows Brisbane, who knows the area, will know that this is arguably the busiest corner of that suburb. It offers the biggest exposure. So if you're a retailer and you don't want to be in a shopping center, like this is probably going to be your your most ideal location. You got massive signage opportunities. You've got obviously foot traffic and entrance from the street level. So in terms of exposure, this is superb. And when you kind of look at, or where is this in the scheme of things? Well, this is where the property is located, right in the corner there. And you are literally moments away from Brisbane CBD. You're literally kind of one sort of station away from Brisbane CBD. So it's a fantastic area. Now, let's just address the elephant in the room. So, hey, it's next to Brisbane River. Isn't there going to be any flood risk? Like, what's the issue there? Are there any issues there? I should say. Well, I'm pleased to say that this property has no flood level. So we did our due diligence and we've checked it. This property is not even on a flood map. So why are we looking at this property? Besides the location, exposure, well, it's really got to do with the numbers. So if you look at where the current tenancy sits, the property is obviously leased out to a bunch of different tenants, but as you can see from here, the total rent that's currently collected is a little bit shy of $330,000 net, which equates to about $274 per square meter. Now, you don't have to be a genius to realize that this is really, really cheap for retail in a major city. The actual retail rents in that location should be somewhere between sort of $500 to $600 per square meter. Some will be a little bit more, some a little bit less, depending on the size and access from the street. But our view is that the market rent should be a little bit over $500,000. That's where the market rent should be. So the idea here is we're going to buy this asset for $6 million, which offers a reasonable yield of about 5.5% net. And then we're going to renew these leases one at a time as they become available. So as you can see, there's a tenant here that's already on a month to month. We're going to talk to them straight away. This tenant's next, and this tenant's next, etc., etc. So over the course for the next 2 years or so, we're going to systematically renew every single one of these tenants and basically bring them to a market rental level. Now, we could lose some of these tenants during that process, and that's fine. We're very confident that we'll find another tenant because of where it is and what it is, and obviously the size of the tenancies that we're looking for as well. So these typically 100 square meter shops, they'll lease very, very quickly. There's huge demand for that type of asset in that particular location. So let's say we are successful over the next 2 years, bringing the rents upwards of $500,000 or more, and we apply a really conservative 6% cap rate, the property should be looking at about $8.5 million in end value. Now, we know cap rates are being compressed right now because interest rates are coming down, so won't be surprised if we actually land at the higher level, maybe around that sort of 8.8, 9% level. So what does that all mean? Well, actually, before I go into this, let me just show you, once the rental reversion is completed, you're looking at an asset that's going to be giving you massive cash flow, over 8.5% net yield, which is wonderful, which is fantastic. So what do the numbers look like? Well, the original asking price was $6.5 million. We negotiated down to $6 million. At $6 million, there'll be some stamp duty, obviously some closing costs, and some loan fees. There's some AL fees, and that's your kind of total acquisition cost, about $6.5 million or so. We factored in some leasing cost. The leasing cost won't be as much as this. This number assumes every single tenant moves out and that we have to replace them. It is very unlikely, but we're being really conservative with our numbers. And this might be some incentives that we might need to offer in terms of rent-free periods or lesser works, etc. There'll be interest payment, obviously, during the 2 years that we hold the property. And we've also budgeted 100 grand for just potential works, just cosmetic upgrades here and there. We're also anticipating maximum 6 months vacancy when we're swapping our tenants, which is really, really unlikely. These numbers are really conservative, but the good news is we're also receiving rent during this process as well. So which means a lot of that gets offset. So your total cost to do this exercise is roughly about $7.1 million. So if you end up with a valuation of $8.5 million, you're going to end up with almost $1.4 million in net profit across 2 years. So that's about a 19% profit margin, 50% return on investment, 25% IRR. And these are really good numbers for a multi-tenanted asset in the CBD location where you're not going to have any prolonged vacancy risks. And the thing is, like I said, these numbers are highly conservative. Most likely what's going to happen is these numbers get cut by half. There's probably a saving of at least $300,000, but these numbers are just hyper conservative. In terms of cash, how much cash is required? So around $2.7 million cash is required to do the deal. And in 2 years' time, you walk away with almost $1.4 million, probably a little bit more than $1.4 million in net equity profit. But most importantly, you're sitting on a property that's going to cash flow you really, really well, and it's going to have very, very low vacancy risks. So guys, I hope you enjoyed this video. I kept it nice and short, just to keep things relatively straightforward. And as mentioned, my name is Will Tong. I'm the CEO of Property Lions, and what we do is we go around Australia looking for value-add commercial properties. So if you are interested, then definitely subscribe to the channel. Please give us a thumbs up, and if you need our services, to hit the link below, and I look forward to seeing you on the other side.